Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now on the program is Katia Dmitrieva, Bloomberg Asia economics correspondent, to take a closer look at the PBOC briefing this morning. So I just ran through the cutting of interest rates, the freeing up of banks to loan more with the drop in the triple R there, also lowering the down payment on second homes. One of our correspondents is James Mager. I know him to be a pretty sober individual, Katia. He says, my hands were shaking as I sent the headlines out. What a bazooka from the central bank. I don't think I've ever seen such an announcement before in China. Katia Dmitrieva, do you agree?
Well, it's not only a big announcement, it also came in about 7 minutes. So you have one of the top officials in China sitting down with the media. He said, "Good morning, so good to see all of you." And then, 7 minutes straight of just announcements of various cuts to loan rates, to the RRR rate. That's how much banks need to hold in reserve, to mortgage rates. So there was quite a lot. The question, though, and I appreciate the commentary on James. I know it was definitely a big announcement compared to what we've seen from China recently. The question is, how much it'll really impact an economy that is so deep in a hole right now in terms of consumer spending, but also the effect of deflation. If you were announcing these policies a year ago, a year and a half ago, particularly the housing market component, this would be a very positive development. You're seeing markets already reacting to the thoughts of, the interest rate moving down, yields have moved down as well. So it would have been a very big kind of bazooka style, which is the term we use for China's fiscal stimulus at this size, would have had a bigger impact if you had announced it a year and a half ago. Now, not so sure, essentially, if this is enough. And we're already seeing some economists saying that.
It's very interesting. I was looking at the headlines, one from the government that we will soon have a release of 6 new measures to support M&A, which I thought was very interesting. And that, in my mind, goes right to the overcapacity story. Now, I know that's a loaded term, so let's not use it. I'll put it aside. But in one industry, let's say, and as an example, electric vehicles, where there's so much overcapacity, is something like this designed to begin to intentionally make the economy maybe a little bit more efficient, to shrink it just a bit? Now, that could have second and third order effects that might be unwelcomed.
Yeah, it could be. It could make it more efficient. It could make M&A, could make the markets just a bit more active. And this is something that the government has been messaging for over a year now, alongside this view of high quality development. It's always, we also want to support the equity market. We want to support the markets. This could definitely do that. At the same time, it's tough when you have a government, especially this year and at this point in the year, that's messaging a 5% or about 5% growth target. And you have companies and provinces and cities that are incentivized to reach that target. So M&A and purchasing other companies and perhaps growing their business that way, maybe that's not necessarily the priority. The priority is trying to get to that 5% growth target by any means necessary. And we've seen that impact across the board.
Some of this is targeted at companies, and some is targeted at consumers, obviously. The refinancing tool for listed companies and shareholders to buy back shares is something that's getting some commentary in our Top Live blog. I'm curious whether or not you think that this does actually move the needle for the average consumer.
It's hard to say. I mean, it is true that in China, about 90% of people own their homes. That's a big difference from other countries. So if you cut the mortgage rate on existing loans, then you free up quite a bit of capital. But the issue in China is not necessarily that people lack money. I mean, there's almost a record in savings right now. It's more the ability or likelihood or interest in spending that money. It's not clear that these policies so far are going to make people feel more comfortable or stable about the market, especially when it doesn't really do much for the labor market. I mean, that's been a key area of concern. You have youth unemployment that's the highest all year. You've got other indicators that are showing people are not getting raises. People are getting cuts to their pay. People are losing their jobs, even in the white collar space. None of this really addresses that.
So, Katia, if you're looking at the policy response today, kind of from outside of China, would you be a little concerned that this is maybe going to add a little bit of, more leverage? And I think maybe if that is true, that there is going to be a little bit of concern about that fact.
It's totally fair concern to have in a country that's already has such a high debt when, compared to other countries. I think it's not, China doesn't really have a choice right now. This is sort of a similar issue. And this is frankly why a lot of officials have been hesitant to unveil these kinds of moves up until now, up until sort of this pain point where more and more Wall Street economists are saying they're not going to reach 5% this year, and also revising lower their estimates for future growth. So they kind of have no choice.
Katia, thanks so much for joining us. So we'll be watching the markets this morning and see how big the impact is. Katia Dmitrieva, Bloomberg Asia economics correspondent. Again, just very briefly, PBOC Governor Pan Gongsheng has announced these policies. The announcement to lower the bank's reserve ratio requirement by 50 basis points, cutting the 7-day reverse repo rate by 20 basis points, and cutting the outstanding mortgage rate. Ben Emons, CIO and founder at FedWatch Advisors. Ben, thank you very much for coming on the show with us. Well, I suppose if you believe in mark-to-market, the Fed would seem to have a lot of work to do here. And the way Neil Kashkari outlined it, as you pointed out, the Fed can cut 150 basis points in fairly short order. Are you in that camp?
Yes, I am, Brian, and great to be back on with you and Doug. First of all, it's now the 8th anniversary of Daybreak Asia Radio, right? And we've been together on this show.
Yeah. No, nine. We hit 9 years exactly last week, and I remember you with us pretty much the whole run.
Exactly. Oh, 9 years even. Thank you for correcting. Yeah. But thank you very much again for having me back. Yes, I am in a camp, and the way I come down to it is that I think, by the way, Neil Kashkari outlines it a bit wonkish, but he outlines it well. You got to really think in real terms, right? Accounting for inflation, and that was, I think, the worry from Waller that came through on Friday was like he saw these inflation numbers cooling off quicker, and where the Fed funds rate is currently, even after that first cut, there's a pretty big difference now in real terms, and they feel. And probably rightfully so, that real rate, that restrictive rate, is still pressing a lot on the economy, even though we're seeing some traction coming through, right, over the last number of weeks in terms of forward-looking data. And so I think they build this building and think insurance against their own forecast, as in they put the 4.4% unemployment rate out there because that's what they think that the employment rate will be, but yet they're willing to cut faster in order to not have that forecast materialize. And they base it upon that analysis, what Kashkari does, comparing the funds rate to the expected inflation and trying to adjust accordingly. And on that basis, yes, they could cut a little faster, which maybe means that is 150 basis points in quote-unquote short order.
We had a number of Fed speakers today, including Austin Goolsbee, and he was saying that current policy rate at Fed funds is hundreds of basis points above neutral. Brian and I were talking yesterday with a guest. I know the neutral rate is largely theoretical. It can't be measured. It's only estimated. We get that. Does it benefit the conversation around monetary policy to talk about a neutral rate? And do you have a sense of where that may be?
Yeah, it does benefit, Doug, because ultimately the neutral rate is really where the Fed wants to get at, where they essentially have achieved the mandate completely. Meaning, like, if we have a soft landing now to get to that mandate, but ultimately it's about price stability and maximum employment, right? So it may be at 3.5%. I think the pandemic and the way the shock played out and all the stimulus and then subsequent investment that's taking place in the United States, with the productivity that has come along with that I think the economy is at a higher trend growth currently than it was pre-pandemic. And that is the reflection of the quote-unquote neutral rate. So the Fed has penciled in close to 3%. The market's pricing something like 3.25%, 3.5%. We'll probably get some sort of vicinity in there if the Fed cuts rates further from here. As in, we're trying to get to some sort of neutral rate. Then we have to assess if that is truly neutral, right? But that's what the market thinks currently. And the Fed's not too far away. Yeah, probably a good guidepost for where we're heading with monetary policy in the near term.
So there's the economy and what it's doing, and then there's the market. We've got the S&P 500 up just under 20% year to date. It gained more than 20% last year. So 20% years is not unheard of, but it would naturally make some people nervous. Unless, of course, you consider that the year before that, 2022, we were down more than 25%. So if you put these 3 years together, you're up about 18% over 3 years, and that's below the average return on the S&P. So I'm confused. Are we fully valued here, or is there more room to run?
Yeah, that's amazing. It's a pretty complicated question because, Brian, because on one hand, you can base this upon the interest rate forecast, right? If we're going to go lower with interest rates, the mechanics are that, stock prices are going to go higher, right? Most of the time, especially if you're in an environment where the economy is actually doing fairly okay, and all that lower interest rates do is just giving the economy more of a push, right? So that should be reflected into the market, and that's sort of what's happening. On that basis, we're not fully valued. We could actually expand in the multiple by just simply higher stock prices. But if you think of if we're still in an economy where there's risk of inflation or risk of exogenous shocks or risk of what we saw this summer, right, of a sudden unwind of leverage in the system, you are at loftier levels, so to speak. And so it is vulnerable to the subsequent volatility that could emerge. Whether this will be the election, I'm not so sure. It doesn't seem to be that the market's so bothered by the election. More, again, something about unexpected coming through the data or other exogenous shocks, whereby one may take note that we do have some disruptions going on in the supply chain again. That may be something that market starts paying attention to as one factor. So I think, to sum it up, the market may look overvalued, but there's more room in the price, especially if you think about interest rates declining in the future.
Our colleagues spoke with the noted strategist Ed Yardeni earlier in the day. Maybe you had a chance to see this on the Bloomberg terminal.
Yeah.
And he said that basically the decision that we had last week to go 50 basis points has lifted the odds of an outright melt up in equities. And he likened it to what we saw in the dot-com bubble. I mean, that sounds a little concerning to me. Does he have a point?
Yeah, he does, because the melt-up obviously is the issue, right? That's the sort of getting really a sprint to the finish here. We've been on a pretty good run here for the last couple of years, and a lot of charts out that the bull market is young and it could have a lot more to go. But what he's talking about is more like you get the sprint at the end. And look, let's face it, we do have an AI boom, so to speak, and there's a lot of data out on it, how much to spend on it, and maybe now being invested again. But there is some form of froth there that we can't deny that, right? And so that's what we have to watch. That's what Yardeni is talking about. If you get a melt up, then the froth from the AI, spending may be unwound right now.
He also warned that central bankers should be careful here with aggressive rate cuts because he thought inflation could resurface. And he highlighted that both candidates in the presidential election are proposing policies that could trigger inflation. So an interesting look there from Ed Yardeni and an interesting look from Ben Emmons joining us from FedWatch Advisors.
Bloomberg Opinion, informed perspectives, and expert data-driven commentary on breaking news.
Time for Bloomberg Opinion, and we are joined now by opinion columnist Minxin, who is writing about China's economic recovery. He's saying the game isn't over for China. but it's garbage time. Minxin joins us from Southern California. Always a pleasure, and the timing is absolutely perfect. As we speak here, Minxin, PBOC Governor Peng Gongchen is conducting a news conference with two other officials, and they are outlining what is clearly just a massive program from the central bank to stimulate the Chinese economy. I want you to weigh in. What do you feel about this?
Well, certainly they try to end the so-called garbage time. The sentiments in China are really bad. I'm no economist, but based on what I have read, the real problem for China is not monetary policy. It is actually low demand, consumer demand in particular. So this policy, lower interest rate, and doing other things probably is good, but not going to make a big difference. That is not a bazooka. One of your colleagues said it was a bazooka. I think it's probably a pistol rather than a bazooka. Because China right now is in a liquidity trap. The money, there's just massive buildup of debt. So the money you pump into the system is just used to pay off debt, rather than to buy stuff or do stuff.
Yeah, for people who haven't read the piece, I can just summarize it quickly in saying that the collapse of the real estate sector has really been a big part of this problem for the average person in China. It's shrunk their wealth considerably, and it's hurt their consumption. But what's interesting is you say that the malaise goes a lot deeper and has political roots to it, that they just don't have as much confidence now in President Xi Jinping as they did maybe when we saw other ructions like in the late 90s, because at that time they had a lot of confidence in the then premier Zhu Rongji. Tell us a little bit more about these political issues that you see.
Oh, yes. I think there are really two issues. For the average people, they think they've given the government enough time to show that it has a better game plan. They have not seen one. Because the economy is just stuck in neutral for now, for the better part of 18 months. So that is, so the government actually has to do something that changes the perception and sentiments. The other is that they doubt whether Xi Jinping will change course. He might do some tactical adjustment, but there is no end in sight of the end of his tenure. He effectively has made himself a lifetime ruler. So people say, well, in the past, at least a leader will be there for 10 years, and then we have a chance for real change. But no such possibility exists at the moment.
So there's no way for the party to put pressure on him to change course here?
No way, because now China essentially has centralized, personalized leadership at the top. Most of the top people are Xi Jinping's friends or allies. So how are they going to put pressure on their patron?
You know, it's interesting, though, with people in China. I think, like Americans, they tend to be opportunistic and confident about the future, and they put a lot of faith in education and Chinese culture, and that's something that sort of supersedes, to a certain degree, political leadership in China. Is there a way that you can see kind of an organic reflowering of optimism, and if so, what might lead to that?
I think it would take a while because China is now caught in this cycle, the debt cycle, the real estate cycle, probably 5-6 years from now. We don't know how long it will take. But I think if the economy recovers on its own or organically, then the sentiments will change. The other is that, as I said, the government really needs to a lot. But the problem is that the government does not have a lot of dry powder that can be used.
So if you had to speculate a little bit on what the reaction of the population in China might be if we have considerably more weakness, no recovery in the property market, persistent deflation in the economy, and just overall weak sentiment, I mean, isn't that a way for the government to begin to kind of maybe second guess itself and change course, or do you think they would be unmoved? The leadership would be unmoved under those circumstances?
I think the leadership will have to react if, for example, we have much higher levels of unemployment. Right now, the latest number on youth unemployment is about 19%. That is very high. And if because low consumer sentiment can create a reinforcing feedback loop. Less income, more insecurity, less spending, so the economy will simply get worse and worse. So I think if the government does not do anything, this is what we can predict. We can count on happening. I think a critical thing is what happens on November 6th of this year, the U.S. election, because the government is saving what little fiscal power that it has in the case Trump gets reelected and slaps huge tariffs on China. And then China will use its fiscal resources to stimulate the economy. But before that, the government wants to just wait. They don't have much longer to wait, so I guess we can see some action at the end of the year.
Well, we had some action today, and we can talk more about that momentarily. Minxin, it's always a pleasure. Minxin Pei, Bloomberg opinion columnist, joining us here on Daybreak Asia.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.